it worth it for them to, to mine Bitcoin. Typically, what they would do is they would mine the Bitcoin, then sell it on the market, and that's how they recoup their costs. Up until May of this year, I want to say about over 50%, maybe 50, closer to 60% of the hash power was located in China. The reason why the Chinese authorities, the CCP, banned Bitcoin mining in May was because they've had these. If you look at the map of China, you see that most of the population lives along the coastline, but most of the power is generated in central China. So they have this massive multi-year program to generate electricity cheaply and then transport that electricity to the population centers. They weren't hitting their targets. They investigated why. They saw that there was some corruption that was taking place in central China, where the miners there were siphoning off electricity to power their Bitcoin miners. So they put a ban on Bitcoin mining, eliminated the problem. What that did was, we can look at a chart that shows this. It caused a massive drop in the hash rate, but the network was still continuing to work. It was just a little bit slower for a couple of weeks because we have something in Bitcoin called the difficulty adjustment, where the Bitcoin network is constantly monitoring the amount of hash power that's taking place. And if the hash power increases too quickly, it makes it more difficult to mine Bitcoin. And this way, you have a steady curve of new Bitcoin that becomes available over time. It's a predictable curve. If you look at gold, the problem with gold is as the price goes up, gold miners that have some supply, they could just dump it onto the market. Or gold, then it becomes very profitable to start mining for gold, and you can just increase the amount of supply of gold, and flood the market with gold, and that would, create kind of havoc on the prices. The nice thing about gold too is that it's a $10 trillion market cap, so it has a lot of liquidity to protect it from a lot of that kind of fluctuation. But with Bitcoin, it's nascent, it's new, and that kind of front-running the hash power and getting a lot of Bitcoin and dumping it on the market could be disastrous to Bitcoin. So Satoshi Nakamoto, day one, put this into this code, the difficulty adjustment. And what we saw was the difficulty adjusted, so it was easier to mine Bitcoin after, after about a 2-week period of time after the ban. So all the miners that didn't unplug, were processing transactions. So there was no real degradation to the network. It might have taken a little longer for those 2 weeks to process transaction. But then we saw that those Chinese miners started selling their hardware to the United States, to miners in Texas, miners all over the world. And so the hash power returned, and we're now sitting at an almost complete recovery of the hash power that existed back in May.
Gotcha. And I
assume story.
And I assume that's bullish for price, but I have no idea why. Can you elaborate on that?
It's bullish for price because the risk of China nationalizing the Bitcoin miners. And when I say bullish for price, I'm really thinking long term.
Gotcha.
I'm really thinking like existential risks to Bitcoin, right?
Gotcha.
Western investors are much more comfortable knowing that they're investing in an asset that can't just be nationalized by the Chinese government. That risk is off the table.
Gotcha.
And the other thing is too, if we look at just how this was a shock to the Bitcoin network, right? I come from a financial technology background. We've done major projects where we've migrated users and we've migrated, technology from one place to another. You need a team of project managers, a program manager. You need, technicians. You need meetings. None of that happened. Yeah. The Bitcoin network did it all on its own. So when it comes to the actual technology itself, it was stress tested and it survived. And the third thing is, the big risk that was on the table too was, how's the U.S. government going to respond? How's the U.S. regulatory authorities going to respond to this, to this asset that has geopolitical implications, right? We see it. And not only did they approve the ETF, but this headline didn't really make too many waves last week, but the FDIC chair said that she's working with banks to develop a framework on how they could hold Bitcoin and other digital assets. That's, so to me, what I'm seeing right now is the regulatory authorities are responding in a way where they're actually embracing it, which is something that I actually did not expect to happen this soon. I thought that would be on a 2023, 2024 timeline. So that's happening sooner. So you have that, and then you have so those are like the weaknesses that are no longer no longer apparent. So that's why I'm super bullish. So when it comes to the SWOT analysis, we've got our strengths. There's no more weaknesses. I can't think of any. The only weakness maybe you could say there's all these new kind of meme coins and other coins that are being released that might attract retail, new retail newcomers, and that's possible. I think number go up. Technology that is inherent in Bitcoin, as people see that number go up, and people have been talking about this number approaching $100,000 later this year. We're going to have that going into next year. As that starts to become true, I think you see some of that retail. I think you see a lot of that retail start coming in, and they'll probably see it as more of an assured kind of eventuality if the price action matches what these predictions are laying out. But also institutions are coming in. I mean, very clearly, and we can see it on the blockchain. We could see, on a semi-regular basis, massive amounts of Bitcoin being bought off of Coinbase, being bought off of the Western exchanges. We're still seeing some Bitcoin come from Asian investors onto some of the Asian exchanges, but it's being really kind of more than evened out. It's net negative flow from the exchanges. And what that means, when you see net negative flow, not only does it mean that people are buying the Bitcoin, because you could buy it and you could keep it on the exchange, right? But that's not what's happening. They're buying it and they're taking it off the exchange. So that does two things. Number one, it's not on the exchange where it's very quick and easy to sell at a moment's notice, right? So you have that downside volatility risk being kind of hampered. And typically the behavior of entities that will move Bitcoin off the exchange is they're moving into deep cold storage. They're holding it for a long term. And we have this concept of short-term holders and long-term holders. The difference between a short-term holder and a long-term holder is 155 days. And you can see many of the Bitcoin that was bought in the last 155 days convert into a long-term holder. It's not like they're being bought and then sold. So it's creating a supply crunch, and we're seeing the effects of that supply crunch right now. That I'll put in the kind of opportunities category is the supply crunch. All we need now is so we have a hardened supply that's being held by long-term holders, people that have kind of a long-term view. All you need now is demand to come in, and then you get once we pass an all-time high, you get price discovery, and from there, I think that's how we hit the $100,000 Bitcoin. I think that's pretty much. I'm very confident that we hit 100,000 Bitcoin within the next 6 months. I don't know when. I remember I was there when no one said that it would hit 1,000. I was there when no one said it would hit 10,000. But the dynamics haven't changed. And if anything, I was worried about inflation in 2008, right? When the bailouts happened. And we didn't really see inflation, but we did see people concerned that absolutely. And that's another thing too, Darius. You hit the nail on the head. You see asset price inflation. What assets do we see inflating more than others? Scarce assets. And what's the scarcest one of them all? Bitcoin. But it's not only like you could create a scarcer asset, but also has that network effect that you won't find anywhere else.
Cool. So on scarcity, so as a reminder, everybody, drop your questions into the queue. Could be about Bitcoin, Ethereum, any cryptocurrency, any digital asset. Obviously, I'm here as well on the macro side. I'm sure plenty of you guys have questions with respect to today's FOMC catalyst, Friday's jobs report. So please dump them into the queue. We'll try to get to as many as we can. We're making it a little bit longer of a show today. We got a late start, and we apologize about that. On scarcity, Omar, let's talk to me about your sort of view on Ethereum, because we're long Ethereum as well in the 42 macro portfolio construction. I've been a little bit surprised at how much better it's actually performed in the last, recent weeks and months relative to Bitcoin. I'm not sure that we need to be splitting that hair in general, because I do believe both exposures are worthwhile at the current juncture as a function of our grid regime forecast. But talk to me about one, the threat to Bitcoin that is Ethereum, and two, if they actually both make sense to hold in an investment portfolio.
I think they do. I think I specialize in Bitcoin, obviously, but Ethereum has a lot of value to it. So if we were to kind of, and I know this phrase is overplayed, but we're going to hear a lot more of it. It's a metaverse. If we were to think that we were to transpose ourselves into the metaverse and we're walking around this virtual world, let's say we're walking down Main Street, right? What are you going to have on Main Street? You're going to have a bank, right? And that bank is secured by consensus and trust, and that's Bitcoin, right? But then you're also going to have a mall, right? And that mall, you might have a mall called Ethereum. And you could go to that mall and you could buy your Shiba Inu, you could buy your ERC20 tokens, you could buy NFTs. And that mall is very popular. That Ethereum mall is a very popular mall. It's got a lot of it's crowded, right? There's fees, and we're seeing those fees go up. I think so. It's a very nuanced thing, right? Because you have opportunity, you have this amazing mall with this amazing network effect, an incredible amount of people that are going to this mall. But on the other hand, you have other malls being built every day, right? Solana. You have faster, better, stronger malls, right? That are gaining traction. So that's where I kind of, if I were to kind of mentally model, what what this new digital asset space is looking like right now. It's Bitcoin is certainty, it's security. They optimize for security. They optimize for decentralization, right? They optimize for scalability, but not on the main chain. That's what layer 2 is all about. That's what Lightning Network and fast payments, fast and pretty much free payments between peer-to-peer is all on Bitcoin. And then when they build another layer, you're going to have, the smart contract functionality that you see in Ethereum, which is lacking right now in Bitcoin. So Ethereum becomes very attractive from that perspective. If we're talking on a shorter time frame, I do see Ethereum outperforming Bitcoin, but I don't see how, I don't see Ethereum as a sound money, because you can always change. And the Ethereum community has had a history. The Ethereum consensus group has had a history of changing the monetary policy at whim, pretty much at whim. I mean, you can go back into history and see that anytime they wanted to do something different, they changed the monetary policy. So you don't get certainty, but you may get an enriched experience. I mean, you have to buy CryptoPunks, which is a very valuable NFT program on Ethereum. And some of the most valuable NFTs are on Ethereum. So you have to go to that mall. You have to buy, if you want to buy those certain products from that mall, and you have to pay the fees. And those fees are going to the Ethereum investors, and they're burning Ethereum tokens. So they're making it deflationary. So I do see that it could outperform in the short term, midterm. But as far as the core baseline, the base layer asset in that world is Bitcoin, because of the certainty. And what we have to be concerned with is there's so many different coins. So if we go out on the risk curve, closest to Bitcoin, you have Ethereum. You might have other tokens like Solana, and a few others. But as you go farther out, and you have your Doge coins, and you have your meme coins, and now you have your metaverse coins way out on the risk curve. Whenever there's a deflationary shock on that stuff, that capital comes flowing back into Bitcoin, right? And you can see that. You see Bitcoin dominance shoot up. So the question you have to ask yourself is, do you want to position if you're going to position yourself farther and farther out of the risk curve, you really got to be on top of it. You really be on top. You got to put your stop loss orders on. You don't want to lose that much out there. You want to make small bets. You want to really limit your downside risk. But then also you can play a different game, and that is just stick to Bitcoin, maybe have some exposure to Ethereum, and just take advantage of the upside potential. If you ask yourself the question, what problem does Bitcoin solve? Central banking. And depending on how you see that, how big of a problem that is, the ability of a small group of individuals to manage the entire monetary supply based on, in some cases, the Federal Reserve uses a lot of data, but there's also some superstition that they use as well. Or a decentralized coin, and Bitcoin solves that problem. Bitcoin is a decentralized monetary system. Ethereum, I would consider it being a decentralized AWS, right? Because you can set up a shop on AWS to sell your goods, right? And AWS is pretty good. What AWS doesn't have that Ethereum does is censorship resistance, right? So AWS, if there's a subpoena from a government authority to shut down someone because they don't like what they're doing, AWS is going to comply. Ethereum, on the other hand, there's no one to send that paperwork to. But keep in mind, too, that Ethereum actually does, a lot of the nodes are actually on AWS. So you don't have a fully decentralized system. Very nuanced. How do you value these things, right? How do you assign risk to these things? And that's really where, that's really where it comes down to the individual, and it comes down to, because it's every day is there. And look, it changes week by week, too. Yeah. It really does, right? So
you're absolutely right.
But I hope I threw enough out there for people to make their own decisions and to kind of see this in maybe a way that they haven't considered.
Yeah, no, you've certainly opened up my eyes in terms of the respect with the relationship between Bitcoin to Ethereum, and more importantly, the relationship between Bitcoin and Ethereum relative to the rest of the digital asset space. I'm going to share my screen real quick and kind of think about my mental model for that. As you know, we've back tested everything that takes in macro with respect to our grid regime process, Goldilocks, reflation, inflation, or deflation. And generally speaking, so right now, you can only see this, but what you see now is in Goldilocks, Bitcoin has a 483% annualized expected return. In months where Bitcoin is in Goldilocks, that has been a historical return. That drops down to 103%. In reflation, ticks back up to they want to say 137% in inflation, and then it's down actually in deflation. Positive side of the horizontal axis here, that means the y-axis value is positive. You typically find that more illiquid sources of risk and return tend to outperform. Whereas when you're on this side of the axis, you typically find that the more liquid, larger cap liquid exposures tend to outperform. Lower volatility, lower beta exposures tend to outperform. And so I think what you're talking about right now is at the risk to all my friends. So I get all these text messages, my buddies who are up 200% in a day on some coin I never heard about. I barely have FOMO, but I'm making a decent amount of money with Grid Zero, so I don't have too much FOMO. But the reality is there's going to come a day where the market stops pricing in this. Right now, it's pricing in inflation. It's been pretty clear. I do believe there's a chance, there's an increasing probability that we could actually go to Goldilocks, if only because that's what the chart's telling me. You look at this move here with respect to the probability that Goldilocks has actually bottomed and come up pretty meaningfully. At some point, we're going to go into a sea of Ds, and that's this sea of blue here. I happen to think mid to late Q1 is when the market will start to, the mid to late January is when the market will start to really start to move towards pricing in those Ds. And when you start to price in those Ds, all those coins that I don't know the names of that are up 450%, people are going to have a really hard time getting their money out of those assets and really off those exchanges. So I definitely, if you, to the extent you're watching and you've made a ton of money in very liquid securities in the digital asset space, be really thinking about trying to increasingly allocate your digital asset exposure back towards Ethereum, back to Bitcoin ultimately over the next few months as we progress throughout this cycle. So any questions?
Absolutely.
Yeah. Absolutely.
Can I just add one thing to that?
Yeah, of course.
If we study what happened on March 13th, 2020, when we had that massive global deflationary event, what we saw was, and so I'm going to talk about it from the extent of what you just described. In the digital asset space, Bitcoin was the least volatile, right? But in the broader global macro, Bitcoin was more volatile than the S&P, than other indexes. It's two ways of looking at it, and you can manage your risk accordingly.
Yep, absolutely. And then I'm getting a question here, so let me go back to the chart. Getting the question here. Thoughts on the Fed tonight? So obviously, you may know the Federal Reserve is updating its monetary policy setting this afternoon to PM. It's very likely that they announce the tapering program, which is the reduction in asset purchases. So I'll start by this, one of my favorite charts. I've been highlighting this really for the last 3 or 4 months, which is the net liquidity, which is the Fed's balance sheet minus the Treasury General account, with the thought process being that those two dynamics work in tandem or sometimes against each other in terms of supplying liquidity to the financial markets. And as you can see throughout this year, we're up $2.5 trillion thereabouts in terms of liquidity provision into markets. This is why the charts of the coins that I've never heard about are doing what they're doing. This is why the S&P 500 is up, making 60 plus all-time highs this year. This is why we've seen such a raging bull market, even though underneath the surface of a lot of assets, we've seen a decent amount of pain, coming from the middle of Q2 to the middle of Q3 of this year. This line, as a function of tapering, is naturally going to start to slow. Right now it's extending at an exponential pace. It's going to start to ascend at a logarithmic pace. The real issue for investors, and ultimately the red line, which is S&P 500, the real issue for investors is, when does this blue line get back to a normal level? Right now, there's plenty of capacity in overnight repo. That's the red line there. Plenty of capacity for the bond market for fixed income investors to absorb the return of the Treasury market in terms of the increased borrowing we're likely to see over the next couple of quarters. But ultimately, once this red line gets back down to where it typically goes, it's going to have a real negative impact on the blue line. The blue line is going to start to go down. I'd be pretending if I said I understood when that exactly is going to happen. I don't think anybody does. I don't think Janet Yellen knows, as she's the Treasury Secretary herself. But I do believe the likelihood of that occurring sometime in the latter part of Q1, early part of Q2 is actually high, and I do believe asset markets are likely to front run that transition. So that's in terms of the Fed meeting today. That's really the main event as it relates to tapering. And then lastly, as it relates to the ultimate the what's the real story in financial markets right now, which is the aggressive repricing of the short end of the curves across most central bank, most sovereign fixed income curves. This right here, I'm looking at what I just circled with the blue line. That's the euro dollar 2022 calendar spread. That's the amount of rate hike expectations investors are pricing into 2022. As you can see, it's gone from just around one rate hike to over two rate hikes, and we're borrowing that primarily from 2024, which is an indication that asset markets or market participants believe the Fed will start hiking sooner and end hiking sooner, because ultimately those sooner rate hikes will have an impact, economic impact. But now we're actually starting to borrow rate hike expectations from 2023. This is new, and to me, this is a very, very different dynamic than just saying, "Hey, the Fed's going to hike sooner, going to finish sooner." This is saying, "Hey, the Fed's going to hike sooner, and it's going to have material impact to the point where we actually start to potentially slow the economy materially in 2023." So this is something I do believe the Fed is paying attention to. I do believe Jay Powell and Bullard and particularly the Hawks on the Fed FOMC board, Bullard, Bostic, those guys are really appreciative of what's happening with respect to this 2022 calendar. But you're going to start to see pushback from the doves on the Fed board to the extent we really start to borrow rate hike expectations out of 2023. And so this whole concept of transitioning to tighter monetary policy has been obviously well received by financial markets, but something that may not come home to rural investors until kind of we get into the early part of next year. So that's that. Let me get back to the chat for some questions. Last question here. What is? Oh, sorry. Go ahead. I got a question. You can chime in on this one too. Omar says, "What is the effect of the blue line going down on Bitcoin?" Well, I can tell you right now, if a large contingency of investors have flowed assets into Bitcoin and into crypto in general and into the digital asset space under the premise, under the guise, under the working, technically true in terms of the actual plumbing and how this all works. But from an optical standpoint, you can make the case that as long as the blue line has a positive slope, we are printing money. When the blue line starts to have a negative slope, and as you can see throughout 2018, and then again, in this early part of 2020, and obviously plenty of times in the chart where the blue line starts to have a flat to down slope, we start to have problems with risk assets. And I do believe that's something Bitcoin's going to have to deal with in the early part of next year. You might disagree, Omar. To the extent you do, please tell us why.
No, I do agree. And anytime I think the Federal Reserve starts to go from an inflationary kind of policy on the U.S. dollar to a deflationary one, people are more inclined to flood out our assets and go back into cash. And if we use history as the ultimate verdict, right? If we are in an incredible inflationary period right now. If we harken back to Weimar Germany in 1917, completely different reason why they got into hyperinflationary kind of scenario there, but it came down to loss of production, right, or shut down of production and increase the money supply. We got that with COVID. We got that at the same time around the world with COVID. If you look at the price of gold during that Weimar Germany period from 1917 to 1922, it was incredibly volatile. As the Deutschmark, his name is Havenstein, who was running the Deutschmark board at the time, changed the monetary policy as related to Deutschmark. So it created this incredible volatility in asset prices. So the question you have to ask yourself is, will the Fed actually carry out the tapering to the full effect and create these massive kind of economic ripples, or will they not? And I tend to believe that it's a lot of bark, no bite, my personal view. And if you look at the history of them announcing rate hikes and that never materialized because the economic data didn't suggest it, we'll see what happens. This is the supply chain issues, the rise of the meme coins, all the different kind of things that are happening right now haven't happened in a long time. It's unprecedented. So I wouldn't be surprised if they take a more through actions, not words. I wouldn't be surprised if they take some, make some policy changes.
Yeah, no, I think.
So how do you position yourself?
Yeah.
How do you position yourself?
Yeah. I think when you talk about the Fed's forecast and their historical inaccuracy, that's one very accurate. I did a lot of research on that in my early days of my career. That's so you're spot on there. There's nothing more inaccurate than a multi-year forecast out of the Federal Reserve. I mean, in fact, go do the opposite at 9 times out of 10. But the thing I'll say about all this, and as it relates to investment and risk management in particular, is that investors tend to have a disrespect for the x-axis, a general disrespect. And what I mean by that is, I think we all understand certain dynamics, like, oh, this might happen, therefore that, the if then statements with respect to things like monetary policy and its impact on financial markets. And then ultimately the Fed might have to pivot because they see the reaction and function of financial markets. But let's not forget that there is, days, weeks, months associated with these processes. And in those days, weeks, and months, you can either make a lot of money if you're positioned for it, or you can lose a lot of money if you're ill positioned for it. And I guess the key takeaway that I'm going to land the plane on with is, if you're ill positioned for a negative inflection in that net liquidity line, it's going to hurt your investment portfolio. Now, whether or not that negative inflection goes down a lot, because the Fed is continuing to pump on the brakes with respect to liquidity provision and the TGAs in asset markets and the economy. So with that, almost everything I know about the digital asset space has been a real godsend to my knowledge, and I appreciate you for all the wonderful work you're doing in the community, brother. Appreciate you.
Real pleasure, Darius. Thanks for having me. Thank you.
Thank you, guys. Catch you guys here next week. Cheers.